Will a market crash at the start of your retirement derail the rest of your retirement? Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking about how to prepare for a market crash early in your retirement. And this started, I was looking at the AARP magazine like I always do. Great article called Make Your Retirement Savings Last, Manage the Risk of a Big Market Downturn Early On, which is a big risk, a big thing to be concerned about. I'm going to put a link to that article, great article by Penelope Wang, in the show notes and in the comments there for you. What this is talking about really is this concept of sequence of return risk, where you might have earned 8% throughout time, but if you're taking money out and you have those losses early, that's just going to make things worse, and you won't have enough money later on to get those high returns that might happen later on, right? If you earn 16% one year and 0% another year and negative 16% one year, if you lost the 16% in year one and then took money out, you have less money to experience that 16% result later on, if that's the third sequence of the return, that you get the higher amount later on as opposed to the higher amount early on. And of course, this is a problem because as you're adding money into your account, it really doesn't matter when you get those returns and those losses. If you happen to have a loss early and you're adding money in, well, you just bought more shares on sale. And if you happen to have the losses later on, that's shares on sale, and you got extra boost earlier into play. So that's why it's called a sequence of return risk. Things might average out, but when you're taking money out of the accounts, when you get those returns matters a lot. That's why Prudential calls that the retirement red zone. And of course, you want to be prepared for this potential. The market might not crash. I don't like the idea of preparing your investments as if the market's going to crash tomorrow, but it might crash. I'm thinking back to 2000, 2008. The market dropped by 50%. The S&P 500 dropped by 50% in those time frames from the top to the bottom. And of course, to get back to even, you have to double your money. If you have $100 and you lose 50%, you're down to 50, you have to double your money to get back up to 100. And as you're preparing for retirement, I'd like you to get ready for that potential. This oftentimes is accomplished with something called a bucketing strategy. But there's more than one strategy out there. I'm going to go through 5 strategies to help you prepare for that market crash that might happen early in your retirement. And I mentioned the first one, which is that bucketing strategy. And the idea is that you set some money aside in cash or something that's like cash so that you can take money out of the cash accounts as opposed to the stock market that's going up and down. So it's called a bucketing strategy. Basically, you have an income or cash bucket and you have a growth bucket on there. I like the idea of looking at a cash bucket or a bucketing strategy. So the question is just how much do you do that and when do you do it? So a couple examples, a couple thoughts. I'm thinking back to 2008 when the stock market was not quite fully dropped in half, but it was on its way, it seemed like. I saw an article, or an interview rather, with Warren Buffett on CNBC, fall of 2008. Warren Buffett, CNBC, in the fall of 2008. And the question was, Warren, how should people invest now that the market's down? And he said they should invest the same way as they've always invested. If you need money in the next 5 years, that money should go in the bank. If you need money longer than 5 years from now, that money should go in the stock market. Now, in the stock market, being 100% invested in the S&P 500 is not right for everybody. 5 years exactly into the bank specifically is not right for everybody. But I like the direction that Warren Buffett's going on. That's saying if you have short-term money needs, you should have short-term money ready for those money needs. And if you have long-term money needs, you should have long-term money ready for those long-term money needs. And of course, the question a bit is, well, how long is short-term? That's a question you got to ask yourself. How long is your short-term? A good model, I think, as you're approaching retirement, is you've probably heard throughout time that you should have 3 to 6 months worth of cash in reserve. That's your emergency fund just in case something happens. Big expense, you lose a job, something like that. Whatever that amount is, 3 to 6 months, 1 to 3 months, whatever that length of time is that you feel comfortable with, if you just reverse or swap that idea of months for years, start thinking in years, that's how much money you should have set aside out of the stock market. And perhaps it's cash, perhaps it's available lines of credit, perhaps it's your whole life insurance, cash value, perhaps it's short-term bonds that don't wildly fluctuate up and down with the stock market. The essence of what's that made up is kind of the next step. But think about how long is your short term, and think in terms of years instead of months. So I've met people that have 1 to 3 years. I've had people with 5 years. I've had people with 7 years. 5 seems to make a lot of sense. That's a number just to think of, because back in 2007, the stock market was at a high point, and it dropped in about 18 months, came back to even, but it took 5 years to do that. So maybe 5 years is just a starting number to think, should I be above or below that number? Hey, that's Warren Buffett's number, he said. So not saying you should have 5 years. That's maybe a number to think of. Another number that seems to make sense as a thought point is 7 years. The reason why is the retirement researcher Wade Pfau. We've had him on the podcast before. We'll link to that in the show notes, writing that down for you. So Wade Pfau did a study that said, how much does this sequence of returns affect you as you approach retirement? And as you approach retirement, as you would expect, the risk of whether the market goes up and down affects you more and more. So your risk goes up until the day you hit retirement, and that day it triples. And then the risk of the stock market into your retirement actually goes down over time because you have less years in retirement the longer you live into retirement. And it took 7 years in his study for that risk to drop to the level where it was the day you hit retirement. So 7 years is a trigger point, a thought point. I think 5 years is a thought point. I think 3 years is a thought point, right? You might have heard 1 to 3 years, 3 to 6, or 1 to 3 months in emergency funds, 3 to 6 months in emergency funds. That 3 number comes up a lot. Think of it in years instead of months. Maybe at the minimum, just 1. Think of 1 year you ought to have maybe in cash as you hit retirement. The market is down about 25% of the time, 30% of the time. That's the historical average. So you got to figure every few years you'll probably have the market down. And the worst thing you can do with the stock market when it's down is take money out of the stock market. And so if you have that 1 year of cash set aside, then you don't have to take money out of the stock market when it's down, and it gives the market then a chance to recover. So think of those years, a bunch of odd numbers, I guess. Think of 1 year, 3 year, 5 years, 7 years. Those are numbers that seem to be triggers to think of. How much do you want to have set aside in cash or things that are somewhat like cash? So that's the first thought, is this idea of if you have a cash bucket and the market drops, that ought to help you out, allow you to recover from the market being down. And the reason why you want to recover is because you don't want to sell at the low point, which comes into number 2, the second thing you can do to be prepared for a market crash early in retirement, is to adjust your investments both before you retire, after you retire, and before and after a market crash. I'm thinking of a few people back, 2 in particular, back in 2020, where they knew they were planning on retiring in the next 12 months. They were going to retire in the next 12 months. And they called me up after the market dropped 30%, after they were let go from their employer, and after they had switched from basically all stocks to all cash. Right? They thought, well, I'm just going to wait till retirement before I adjust my investments. You're going to retire soon. You're going to retire in 1 month, 6 months, 1 year, 3 years. However much you think you ought to have in your cash bucket as you're thinking through it, that's maybe how many years at least you ought to be preparing for things ahead of time. If you want to have 7 years of money in your cash buckets when you hit retirement, and you're 5 years away from retirement, project out those 7 years and say, oh my goodness, in year 6, in year 7, I really want that money in cash. If the market's near a high point, if you're within 5 years and you're thinking things through, adjust your investments ahead of time. The reason why economists, advisors say you don't make changes, you don't want to be, you want to be greedy when others are fearful, and fearful when others are greedy, is when the market drops. That's historically the best time to invest, and that's when you have the highest stress and you want to get out of the market. And if you're looking towards retirement, oh my goodness, what if this, whatever just happened, right? Back in COVID, and the market dropped 30% basically in about 2 or 3 months. You're thinking, I'm retiring in 3 months. What if it drops another 30%? I better make a change now, right? You want to make those changes ahead of time. You want to be proactive with those changes instead of reactive. So you want to adjust your investments, projecting out the cash flow that's in the future. If you're going to have times in the future when you need the money and time has gone through, your short term's coming up. Adjust those investments before you retire. Don't adjust it. Don't wait till you hit retirement just to make that adjustment where you bring the risk down, because you might overcompensate, right? These people were 100% stocks. They went to 100% cash. And maybe if they were just kind of like half and half, we'll just call in the middle. If they were just half and half ahead of time, they might not have gone to 100% cash right when the market was going up, because that's what happened back in 2020. The market dropped and then started going back up, and they were missing out on the money going back up. And of course, things happen. Your investments change every single day, right? They're going up and down every single day. And when the market goes up, you might have more risk than you signed up for. So keep an eye on adjusting your investments through something called rebalancing. Whatever amount of money you have in your short-term bucket, your cash bucket, if you're using this bucketing strategy, whatever level of risk you want to have in that growth area, that growth bucket, that's going to change over time. And if it changes too much, you'll have more risk than you expected or not enough risk. And you want to rebalance it to get back to where you want it to be. The market's going to move things around, and you got to take that proactive action to change things to get back to where you might want to be. Now, the third step to be ready for how do you prepare for a market crash is understand that you need to be flexible. And by being flexible, perhaps you don't take out as much money from your investments. One of the knocks on the 4% rule is that if you start out with $1 million and the plan is to take out $40,000 per year, adjusting for inflation, and all of a sudden the market drops, right? Then you're taking money out of the market at the wrong time. Well, a lot of other people come into the ideas that you ought to be flexible. We had an interview with Justin Fitzpatrick, and Justin runs a company called Income Lab, where they are a software that's for financial advisors that help you figure out what's the range, what's the proper kind of level that you can take out. And if the market goes up, can you afford to take out more? If the market goes down far enough, how far can it go where you don't have to change your strategy, but maybe it does go far enough down, the market drops far enough that you do have to change your strategy. Being flexible with your strategy might actually allow you to take out more. That's what all the research is showing. If you're flexible with your strategy, you might be able to take out more at the beginning, and it might be able to help you out later on that you're being proactive and understanding, all right, if the market drops far enough, I will take out $500 a month less, and I'll just tighten my belt, and I'll be able to do that. Or you think of this 4% strategy where you're taking more and more with inflation. Well, maybe you just skip an inflation pay raise. You say, I'm taking out $5,000 a month and inflation was 4%. I should make it $5,200 a month just to match this 4% rule. But the market's down. I'm going to skip that $200 a month raise, and I'm just going to tighten my belt at the same $5,000 a month. So being flexible with your investment strategy, your withdrawal strategy really is one way to be ready for that market crash. And we want you to be ready ahead of time. It's not, is the market going to crash? Is the market going to drop? It's more likely to win. And of course, define crash, what that might be. I think crash really is more about what makes you uncomfortable. That might be a 10% drop, 20% drop, 30% drop that's out there that says, oh my goodness, I'm uncomfortable with what's going on. If you're prepared ahead of time by knowing that you're rebalancing when the market's high, getting ready to rebalance when the market's low to take advantage of some prices being low, having cash on hand and saying, I'm going to be proactive. If and when the market drops, I just will not take out as much money. And here's my plan ahead of time. If you got a plan ahead of time, you're going to feel a lot more comfortable making some great decisions on there. Now, the fourth step, interesting one. You might not expect to hear this from a financial advisor on one, but if you're ready for a market crash, step 4 is you might want to borrow money to live on. And that seems interesting. Why would you want to go in debt, especially when things aren't looking so well? Well, it's kind of a point of what's worse. Is it worse to borrow money, or is it worse to take money out of the stock market when it's low? You could have a different opinion on there, but if you plan for it ahead of time and know this is the plan, then I think that's a good way. There's a lot of research that suggests borrowing money perhaps when the market's low is a better deal than selling out of the stock market when things are low. And I'm going to be loose with this idea of borrowing money. Borrowing money might be borrowing money out of your cash value life insurance contract. Borrowing money might be saying, I'm going to take money out of my personal savings where I generally like to have, 50 grand maybe in my savings account, but the market's down. So I'm going to take 25 grand out of my savings account instead of 25 grand out of the stock market. Maybe borrowing money is really from yourself. Or borrowing money might be having a line of credit already ready to go, not using it until the market drops and saying, well, I'm going to live off this borrowed money so I don't have to sell out of the stock market. And if and when the market comes up, then I can take that to pay off my borrowing. So having that mindset that perhaps strategically borrowing money is a good way to help when the market's down. And the fifth and final step of how to prepare for a market crash is to build your guaranteed income. There's an interesting article, I'm going to link to that, where the people who had some sort of guaranteed income, whether it was Social Security or a pension or even a private annuity, they felt more comfortable when the market dropped. They felt more comfortable spending their money over the lifetime. They felt more comfortable to the point where they actually spent more money and enjoyed the money even more. It sounds like a win where you can enjoy your money more. That's a good way to go. And a way I'd encourage you to think about your guaranteed income is something called the income stability ratio. I'm exploring with that a little bit, trying to think of how to best model that, how to best make use of this. But the concept is, of all the income that's projected, right? If you're going to spend 50 grand a year for the next 30 years of your retirement, that's $1.5 million that you would expect to spend, perhaps take out of your investments or get out of your guaranteed income. If you're going to spend 50 grand a year for the next 30 years, 1.5 million, and you're going to bring in 30,000 a year for the next 30 years from Social Security and pension, you've got 1.5 million that you're spending, 900,000 coming in from guaranteed. Your income stability ratio, in that case, let me make sure I get the math right, 9 million into the 1.5 million, that's at 60%, right? Your income stability ratio is at 60% in that example. And if you see the market drop and my 60%, I can pay my bills, I'm not getting kicked out of my house, I'm going to be fine. If you look at that number and feel as if you're going to be fine and you're willing to put up with the ups and downs of the stock market, then maybe you've got the right level of guaranteed income. But if you look at it and say, oh my goodness, I can't stomach the idea that 40% of my income is coming out of the stock market, is coming out of my investments, is subject to the ups and downs, then maybe you do need to find some more guaranteed income. And usually the best way to find guaranteed income is to, number one, look at your Social Security and see if perhaps you can wait, which allows it to become a higher amount. You might still have a pension. I'm still running into people that have pensions, and maybe it's a pension from a long time ago, and maybe it's only a few $100, but it adds up to dollars that you can get over your lifetime, and maybe waiting on your pension to get a higher amount is a good way to go. And perhaps even some sort of private annuity where you say, I'm done with the stock market, I'm done with the bond market, I'm going to shift this money over to an insurance company, and they're going to start paying me an income over the rest of my life. That's worth exploring. It's worth exploring Because I think in 2024, with interest rates being higher, and I'm recording this in late July 2024, the stock market is near all-time highs. If there's a time to explore, do I start shifting things over to a private annuity? You want to do it when you're kind of selling your investments at a higher point and trying to buy in at a high point of good interest rates. And interest rates are at a 25-year high. Market's at an all-time high. It's worth exploring in general, but especially might be worth exploring right now is, am I better off taking a portion of my investments and shifting it over to private companies so that I'm not having the investments, I'm having the income? And if you do that, you want to make sure you do it based on what works best for you. Not because the salesperson's telling you it's a great idea or, oh, you can make 8%. No, you got to look at first, I like this idea of the income stability ratio. Look at all the money you're planning on spending over time, all the money that's going to come into you from your guaranteed income over time. What's that ratio? Is it high enough that you say, I've got all the guaranteed income I need, perhaps annuity is not right for you? Or is it too low? And you say, oh my goodness, I would absolutely freak out if the market dropped and I know that only half my money or 20% of my money or whatever that number is for you, oh my goodness, I don't have enough coming in guaranteed for the rest of my life. I might be making some bad decisions with my investments if and when the market drops. Then if that's you, look at increasing your Social Security, increasing your pension by waiting, and perhaps buying that private annuity. So the 5 steps to prepare for that market crash early in your retirement is to perhaps have a cash bucket, have that bucketing strategy where you've got some money in cash. Know that you ought to rebalance your investments so you've got the right level of risk. And you do that before you hit retirement. You do it after you hit retirement. You look at it consistently. Perhaps you're rebalancing because the market's high. Perhaps you're rebalancing and buying in because the market's low. Step 3 is make sure you're flexible. Don't stick to this rigid schedule of I have to take out this exact dollar amount for the rest of the time. And I have to give myself a pay raise every single year for the rest of the time. Be flexible and understand that perhaps taking a little bit less money when the market's down, tightening the belt when the market's down, allows you to enjoy the good times later on. It allows you to have the money left over later on. Step 4 is maybe you borrow some money to live on. And you might not expect to hear borrowing money on a financial podcast, but if you plan for it ahead of time, and borrowing money might just be straight from yourself through kind of borrowing money from different parts of your financial picture to put in your checking account and live on while the market's down. And step 5 is to proactively ahead of time build that guaranteed income. If you've got enough income guaranteed and you know what's coming up every month going forward, the studies show you spend more, you enjoy it more. I've got a feeling you might make better decisions on your money when the money goes down, and that's what we're here to help you out with. I want to thank you for listening to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money, and you will make better money decisions. Hi, I'm Jeremy Keil, owner of Keil Financial Partners, and if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to KeilFP.com. That's KeilFP.com.